Hello again to everybody. For those of you that have been with us from the beginning, you remember we initially set the foundation of this entire program in Module 1 with the Introduction to Accounting. Then we expanded it by going through the 3 financial statements, the income statement, balance sheet, and cash flow statement, as well as their 3 components to see how they worked both individually to understand an organization as well as collectively. Then we moved into understanding the next level up in our chain, which is finance. What were the 3 pillars? The working capital, capital budgeting, and capital structure. And then deeper into working capital and its components and the various approaches to working capital. And then capital structure, which can either make a long-term project successful or in some cases kill it, which led us directly into one of the most fascinating parts of finance, but truly the most risky, which was capital budgeting. What we're going to be doing today in our financial analysis model is go through starting with ratios. Ratios are one of the easiest ways to do financial analysis to perform it on any organization. A ratio, of course, is nothing more than the proportion of 2 numbers. So it's very easy mathematically to calculate. And the question is, which ratios to choose and what do they tell you? Well, part of that is answered by breaking these down into 5 different categories. We have liquidity ratios, which measure our ability to meet our short-term obligations when due, as we're projecting forward. And we'll look at a variety of those. Same thing with the utilization or turnover ratios. How are we using the assets we have, specifically our working capital assets, in proportion to the need? The leverage ratios go back to the conversation we had in capital structure about leverage, the proportion of long-term debt to equity, but there are other ways to measure this that we'll go into. Profitability ratios, of course, are important not only internally, so we know we're creating the margins that we had anticipated on our plan, but also to the marketplace to make sure from an investor standpoint and a lender standpoint that we're achieving the level of profitability not only desired, but required to meet our obligations. And then the last of the 5 categories are market ratios, and we'll talk specifically about the risks in using these ratios in just a moment. So we'll start with liquidity ratios. And the reason we start with liquidity ratios is we always need to make sure that we can meet our short-term obligations before we ever look at long-term. There's a whole expression in finance. Unless you can meet your short-term obligations, you won't be around to worry about your long-term situation. And that's so very true. Although both are important, we always start with liquidity. And liquidity generally is broken down into these ratios. And not only do we have them here on the slide, but if you have looked at your Excel workbook, I created a template for you with about 4 dozen ratios. We've got the formulas in there. We've got the definitions for each. And all you have to do is take an input the balance sheet and income statement for the organization you're analyzing into the spreadsheet. All of the calculations for the ratios can be done automatically. And the reason we have put 5 consecutive periods there is it's fairly traditional in financial analysis and certainly in commercial banking to look at 3 to 5 consecutive years of financials to look for trends. Because when we're doing financial analysis, and very specifically when we're doing ratio analysis, we're looking for a combination of the ratios of the current period, that's called vertical analysis, and the potential for trends over time, that's called horizontal analysis. In other words, you could take this very first ratio, the current ratio, which is nothing more than 2 of our working capital assets, working capital components. Current assets divided by current liabilities will give us our current ratio. And whatever that ratio comes out at 1.2, 0.9, 3.6 to 1. It gives us a little bit of information because all ratios are little pieces of an overall puzzle, but we're not sure how good or not good that ratio is until we compare it to something. So remember, when you're doing financial analysis, and specifically ratio analysis, to have a benchmark, a comparison in which to apply the particular ratio. So you'll know if it meets the target or not. So with our current ratio, if we look at it in 3, 4, 5 consecutive periods, we can see, is there a trend? Is the trend positive? Is the trend negative? Is there no trend? The difference between our current ratio, which is a fairly standard measure of working capital, and our quick ratio, as you can see, is we've merely taken out from the numerator the least liquid current asset, which is inventory. It's a more conservative approach to looking at our liquidity. And of course, a cash ratio, which is rarely applied from a practical standpoint, does give us one more comparison point. So whatever ratios we're calculating and however we're using them, you want to determine in advance. Are we going to compare these ratios to themselves over time? Are we going to compare them to what the industry typically does? That would be a peer review. Are we going to compare the ratios to what the company has done in the past? Or are we going to compare the ratios to their projections? So you've got 4 different ways to use these ratios to make informed decisions. Your working capital turnover is nothing more than your sales from your income statement divided by your working capital from the balance sheet. Again, that measured against a target and over time is going to give us a much better idea of how the organization is using their working capital. If we move to the utilization, or what's called the turnover ratios, these are tied directly to measuring our operating and our cash cycles. And we'll look at those in a moment. To measure our inventory turnover, if we're a product-based company, we're going to look at our cost of goods sold from our income statement. If we've got a service organization we're analyzing, of course, there won't be any inventory turnover, so we'll move on. But if the organization manufactures, distributes, or in any way has inventory, we want to know how many times per year are they effectively building up the inventory, selling it off, and replacing it. Here's a caveat. Whether we're talking about inventory or receivables or payables, we definitely want to remember and recognize this is going to measure the average, not the absolute. So when we look at inventory turnover and we calculate the number of times per year that we're turning over the inventory, that's not going to tell us what we have in stores that may be damaged, obsolete, or in some other way not saleable. It won't tell us that in reality, if we measure this as 6 times, which means if you move to the next ratio, day sales in inventory will be about 60 days. Again, that's average. It won't tell us which pieces of inventory have been sitting around for 4 years when other things are turning over in 12 days. So please use that as a caveat. But if we calculate our inventory turnover first, then divide that into the number of days in the year for the days sales in inventory, it gives us a very simple way to understand how long our average piece of inventory is sitting in the warehouse. How does that compare to how long we wanted it to sit there? Critical. We'll do effectively the same thing with receivables. We take sales from the income statement, accounts receivable from the balance sheet, divide the result into the number of days in a year, tells us how long it takes us to collect our average receivable. There's always a goal in every organization of how quickly we want to turn over our inventory and how quickly we want to collect our receivables. This is very important for managing our working capital, as we talked about previously, managing our liquidity, and it's a clear indication of how we're managing our business. And the next thing we can do is, again, look at the relationship between our sales and our net working capital. It just gives us a clear indication of how well we're using our working capital in supporting our sales, which we hope would grow over time. Two other quick ways to look at how we're actually using our tools, our assets in our organization. Our fixed asset turnover takes our sales, the revenue we're creating, in proportion to our investment in net fixed assets. This really tells us, for the tangible assets that we had acquired through our capital budget, as we looked at in the last module, what level of sales are we creating? Are our sales increasing over time while our investment in fixed assets are staying relatively static? If that is the case, then we're becoming more efficient over time, which is generally what we would like. But here's the big caveat. This is our net fixed assets. So if you compare company A to company B, their fixed asset turnover, sales divided by net fixed assets, are the same in a given period of time. Great. Then we look at some later date, and one organization, we look at their sales to net fixed assets, and that proportion is rising steadily. So it is a clear indication that they're being more efficient. Or are they? If an organization is not reinvesting in fixed assets, which of course we get some indication by looking at the cash statement, remember their cash flow statement. If we look at the investing side, we'll see if and how much increase investment in capital assets an organization makes in themselves. So if an organization is not really investing in their own growth, they're not increasing or at least replacing their fixed assets over time, this denominator could be reducing, could be getting smaller. Even if the sales number is not getting larger, the indication is that the fixed asset turnover is improving when in fact it is not. So here's a very important point. Be careful to not just look at the fixed asset turnover in an absolute sense. Look behind the numbers and make sure that if this number is improving, if this ratio is looking better, it's because sales are going up, while the assets that need to be replaced are. Not just that an organization has very old assets, they're depreciating to zero with sales not increasing, giving us a false sense that this ratio is improving.